Welcome, fellow investors, to today's presentation on unlocking finance for your property portfolio growth. We are excited to share with you some invaluable insights and strategies to help take your property investments to the next level. Let's begin by assessing your financing needs. As property investors, it's essential to have a clear understanding of your investment goals and the capital required to achieve them. Whether you're looking to acquire new properties, renovate existing ones, or expand your portfolio. Next, let's explore the various types of financing available to property investors. From traditional bank loans to private lenders, equity partnerships, and crowdfunding platforms. There's no shortage of options when it comes to raising capital for your investments. Traditional bank loans offer low interest rates but come with strict qualification criteria and a lengthy approval process. While they may be suitable for some investors, others may prefer more flexible financing options with faster access to capital. Private lenders and hard money loans provide faster access to capital, making them ideal for investors who need quick financing or may not qualify for traditional bank loans. However, it's essential to be aware of the higher interest rates and more flexible terms associated with these options. Equity partnerships involve collaborating with investors who contribute capital in exchange for an ownership stake in the property or project. While this option provides access to additional capital and shares risk, it may result in a loss of control for the primary investor. Crowdfunding platforms allow investors to pool funds from a large number of individuals to finance real estate projects. This option provides access to small investments from a diverse pool of investors but requires careful consideration of regulatory considerations and potential risks. Asset financing refers to the use of a company's balance sheet assets, including short-term investments, inventory, and accounts receivable, to borrow money or get a loan. The company borrowing the funds must provide the lender with a security interest in the assets. Asset financing differs considerably from traditional financing, as the borrowing company offers some of its assets to quickly get a cash loan. A traditional financing arrangement, such as a project-based loan, would involve a longer process including business planning, projections, and so on. Asset financing is most often used when a borrower needs a short-term cash loan or working capital. A personal loan is an amount of money you can borrow to use for a variety of purposes. For instance, you may use a personal loan to consolidate debt, pay for home renovations, or pay the legal fees in a property purchase. Personal loans can be offered by banks, credit unions, or online lenders. The money you borrow must be repaid over time, typically with interest, and is normally more expensive than traditional bond finance. Some lenders may also charge fees for the raising of the loan, which makes it even more expensive, so beware the lender. A real estate partnership is a group of investors who pool their money to invest in property purchasing, development, or leasing. Normally, a partnership has a general partner who assumes full liability and one or more limited partners who are liable only up to the amount they contribute. The general partner is usually a company, an experienced property manager, or a real estate development firm. The limited partners are outside investors who provide financing in exchange for an investment return. Seller financing is a real estate agreement in which the seller handles the mortgage process instead of a financial institution. Instead of applying for a conventional bank mortgage, the buyer signs a mortgage with the seller and the buyer pays a fixed monthly amount to the seller based on a certain time frame and interest accrued. Venture capital is a form of private equity and a type of financing for startup companies and small businesses with long-term growth potential. Venture capital generally comes from investors, investment banks, and financial institutions. Venture capital can also be provided as technical or managerial expertise. Another form of private funding is angel investment. An angel investor provides initial seed money for startup businesses, usually in exchange for ownership equity in the company. The angel investor may be involved in a series of projects on a purely professional basis or may be found among an entrepreneur's family and friends. The investor's involvement may be a one-time infusion of seed money or an ongoing injection of cash to get a product to market. Angel investors aren't usually in the loan business. They're putting money into an idea they like, with the expectation of a reward only if and when the business takes off. Rent-to-buy properties are properties that include a clause in the rental agreement which either gives you the option to buy or an obligation to buy after a certain time period. You make rent payments each month and a portion of those payments can count toward your down payment. Should you decide to buy, the excess money can be applied to the property purchase. Renting to buy can be an appealing concept for people who are interested in owning property but have thus far been shut out of the traditional home buying process. If you don't have a sizable down payment, for instance, or your credit score is too low to qualify for a mortgage, renting a property with the intention to buy it can give you time to save and work on improving your credit rating. The rent-to-rent method works for almost any type of property investment and is also widely used in the short-term tourism rental market, like Airbnb. With this method, you are creating cash flow without taking ownership of the property, by renting the property from the owner and then subletting to tenants. Finally, one can purchase a property as one does a car on the installment sale method. In this method, the seller retains ownership of the property until the full purchase price is paid over a set period of time in a set number of capital installments paid by the buyer. The seller may charge interest and add it to the purchase price in the agreement as if the buyer was paying off a bond. Now that we've explored the different types of financing available, let's discuss where to find financing for your investments. Networking within real estate communities, establishing relationships with private lenders, and utilizing online platforms and forums are all valuable strategies for accessing capital. Building relationships with other real estate investors, professionals, and lenders can provide valuable opportunities for accessing financing through referrals and recommendations. Directly connecting with private lenders through networking events, industry conferences, or online platforms can lead to potential financing opportunities with more flexible terms than traditional banks. Utilizing online resources such as real estate forums, social media groups, and crowdfunding platforms can help investors discover alternative financing options and connect with potential lenders or partners. Using other people's money, or OPM, is a powerful strategy for property investors. By leveraging capital from investors, you can expand your portfolio without depleting your own resources, ultimately maximizing your returns on investment. Effective strategies for utilizing OPM include structuring attractive investment proposals, conducting thorough due diligence to mitigate risks, and establishing clear communication and trust with investors. When raising capital from investors, it's essential to structure your offer effectively. Providing a clear investment proposal, demonstrating potential returns, and establishing trust and credibility are key elements of a successful fundraising strategy. Illustrating the potential returns on investment through detailed financial projections, market analysis, and comparable property performance can help instill confidence in investors. Building trust and credibility with investors by showcasing past successes, providing transparency in financial reporting, and offering personal guarantees or assurances can increase investor confidence in the investment opportunity. When raising capital from investors, it's crucial to comply with relevant securities laws and regulations to avoid legal issues. This may include registering the offering with regulatory authorities or ensuring exemptions are met. Working with legal experts to draft comprehensive investment contracts that outline the terms, conditions, and rights of investors is essential for protecting both parties' interests and minimizing potential disputes. Consideration should also be given to the flexibility of financing terms, including repayment schedules, interest rates, and exit strategies, to ensure alignment with investment goals and risk tolerance. Evaluating how each financing option aligns with long-term investment goals, such as portfolio diversification, growth objectives, and risk management, can help investors make informed decisions. Finally, you should consider creating a financial plan for growth. Developing a detailed budget that accounts for acquisition costs, including purchase price, closing costs, and renovation expenses, is essential for accurately assessing financing needs and planning for future growth. Conducting thorough financial analysis to project cash flow, net operating income, and return on investment can help investors assess the profitability of potential property investments.
Thank you for being part of the EDPF Academy #1 Title Deeds project. We hope you will continue your journey to property ownership with us by registering for our Academy course at www.edpfacademy.app or visit our main site at www.edpf.co.ca for more information about EDPF.